Morning, everyone. Thank you for joining us the day after the Chancellor's spring statement. We have been crunching the numbers here at the Resolution Foundation and ready to give you our analysis. I'm delighted to be joined by Richard Hughes, Chair of the Office for Budget Responsibility, and Linda Yu, economist, writer and broadcaster. For those of you who follow Stephen Bush on social media, he was going to join us this morning, but unfortunately has had trouble with his house move. So can't make it. So we will hopefully have Stephen along to a future event. And first, I'll invite James Smith, our research director, to give us his hot take.
All right. I can't believe for Stephen Bush, the spring statement is not the biggest thing going on. So it's different priorities. Well, thank you, Ruth. Thank you all for joining us. Nice to see you all here. My job is to give you a whistle-stop tour of our overnight analysis. I'd like to thank the RF staff for being up all night, bleary-eyed, preparing a lovely document for all you this morning. I would commend that document to you. There's plenty in there to get into. So what I'm going to do is really focus on the living standards implications of the spring statement. And this was basically meant to be a non-event that has become the main event. So we were discussing how we should try and summarise for you exactly what we think of the Chancellor announced yesterday. And I think there's really sort of two bits to this. So one, where we're very positive. So we think it's good. The Chancellor has recognised the deterioration in the public finances, responded very decisively to that. But we are less happy that she has done so by cutting welfare benefits, and that will really affect the living standards outlook. So I'll take you all through that, focusing on those living standards implications. And let me start very briefly with the economy forecast, where I was all set to say to you today how bleak it was all looking in terms of the economy forecast, how much weaker things all were. And if you look at the very start of the forecast, and this is the thing that people have really focused on, the OBR has basically halved its growth forecast for this year. So that's a really big markdown. With this forecast and looking at 2024 and 2023, we've got GDP per capita below 1% for 3 years for the first time in about 30 years. So this is an incredibly weak set of forecasts viewed on that basis. But if I build on, and there's more to this chart, if I build on what's going on in the OBR forecast, if you look at the red dotted line, Richard and his colleagues have responded to that bad news by marking up the forecast. And it now, if we compare it to this range of other forecasters out there, it now looks basically like the strongest forecast we can find for 2026 and 2027. So a very strong forecast in the medium term, a pretty optimistic boosterism-like forecast from Richard, so we're looking forward to hearing all about that. So the weaker economy is actually playing less of a role in this forecast than we had thought it might. But one thing that definitely is playing a role is higher interest rates. So if I show you what's been happening to the cost of government borrowing since the OBR data cut off ahead of the autumn budget, you can see that globally the cost of borrowing has risen. It's risen a little more in the UK if you zero in on the blue line here. And you can see a very high degree of co-movement between the UK and other countries here. And really what's been going on is largely a global phenomenon, but worse for the UK. And the other thing I would just point out is if you look at the difference between the OBR forecast window for the data for the autumn budget and compare it to the other shaded area, most of the rise in yields, they've bounced around over that period, but most of the net rise in yields was visible at the time of the autumn budget. So this forecast deterioration should not have come out of absolutely nowhere for the Chancellor. We already had higher interest rates even around the time of the budget. So So let me show you what that does to the fiscal forecast. You come here early the day after a fiscal event, you're going to get a complicated fiscal chart. So I don't like to disappoint you, I know you love these, but the blue bars here are really showing you what the effects of those economy changes, what they're doing to borrowing. And I'd focus in on the light blue bar on the right of this chart, and that's showing you the effect of higher interest rates on borrowing. So about 10 billion deterioration in borrowing just from that rise in global interest rates. And if I build on how the Chancellor has responded to that and show you this net change in the borrowing position, then you can see that the policy is really here in the red bars, and the Chancellor has made some changes to spending and done some cuts to benefits. I'll tell you more about that in a moment, but the thing to concentrate on here is the policy response is very backloaded here. So the fiscal position has been improved by by those measures to tighten policy, but that comes towards the end of the forecast period. And actually a big feature of the spring statement is that the Chancellor is borrowing more in the sort of short term, and that we've got this higher spending through much of the period here. So that basically shows you what's going on in terms of the fiscal position. If I just update you on where the government is on its fiscal rules. Again, you can see the effect on the left. If I show you what's going on with the government's current balance rule, this is basically balancing day-to-day spending and tax receipts. You can see that borrowing is worse basically all across the forecast, particularly on a pre-measures basis. That's the dark red line. You've got to be able to spot different shades of red here. And if you look on the left-hand chart towards the end, you can see in a supreme piece of fine-tuning here, the Chancellor has returned her headroom to precisely the same as it was at the autumn budget at 9.9 billion. So very, very precise set of fiscal numbers here in terms of policy, very precise fine-tuning. The chart on the right shows you what's going on against the government's net financial liabilities target, where that measure is falling as a share of the economy and gives a little bit more headroom. But a key thing to emphasise here is that with headroom at that same thin level that we saw at the October budget, that means that the sort of issues that we've had this time, where a forecast deterioration has demanded a policy response to hit the fiscal rules, that risk is there again in the autumn. So there's a good chance that we're doing this all again in the autumn, and the Chancellor has to come back for more tightening, and not least because of all the risks that Richard and his colleagues point out in their excellent EFO yesterday. And we're already seeing those risks crystallise this morning with Donald Trump talking about higher tariffs and Richard having to respond to them on the radio in real time. So that's a good morning for Richard, but definitely big risks to the outlook here. So I'll now get into the policy response. I want to say a little bit about what's going on the spending side first. And I suppose the kind of key thing to keep in mind on the spending side is that we got a very big change in overall spending at the time of the autumn budget. So this might be the most boring chart of the entire morning, but I think it's important to emphasise that there were pretty big top-ups to government day-to-day public service spending. That's the light blue bars on this chart relative to the previous government's plans in dark blue. And what the Chancellor announced yesterday really tweaks those plans to some degree. So you can see in the near term by those very thin slivers of green that the Chancellor is actually spending more in the near term, albeit by not very much, and then is actually reducing spending towards the end of the forecast period. So we've got this 3.6 billion endpoint cut to the overall size of Ardell. But these bars are very obviously going up, so it's not austerity. So this was a very different picture during the period of austerity. But if I show you what we're worried about here, it really comes out by comparing the departments where spending is ring-fenced, set aside, particularly on the left here for NHS Health, where the spending is really heading off into the stratosphere, and defence, where the government is spending more given the global situation. But if you take those protected departments, they're doing pretty well, but if you look at all the other departments, they're doing rather badly. So we don't have numbers for this, we'll get full details for spending review, but what we've tried to do here is allocate those cuts across those unprotected departments, taking into account what's been going on with those protected departments. So you can see much of the increases that were put in place at the time of the autumn budget, those are now set to be, something like 2/3 of them are now set to be unwound by those cuts if you just do this evenly. So coming into the spending review in June, we'll see a lot of this allocated, and we'll start to see some really tough decisions for the Chancellor there. So the big cornerstone to the policy announcements yesterday were really on the benefit side, and obviously we got the green paper in the run-up to the spring statement. So you've seen a lot of this, but we got much more detail yesterday about what's going on. And before I say anything else, there is a strong case for reform on health-related benefits. I don't think anybody disputes that. And there were some genuinely helpful reforms that have been announced as part of this package. So increase support for people on health benefits trying to get into work, although that support, if you look at it, comes very backloaded in the forecast period, whereas the cuts come a little sooner. So that's something we worry about. And then here I'm showing you what's happening with the increases in the standard rate of universal credit. And you can see the government raising that level is basically chopping down something like half of the fall that we saw over the 2010s. So a genuinely significant change in terms of boosting the standard allowance of UC. And that will provide some incentives at the margin for people to not claim health-related benefits. So that's the good. You will know the cliche is coming, so it's not all quite so good as far as we can tell. There is some genuinely really big cuts that have come alongside all that. And the big cuts are really coming to personal independence payments. So there's around 5 billion of net cuts that are coming through here. But that net figure that people are talking about, that hides a gross figure once you take into account some giveaways of around 8 billion in terms of overall gross cuts. And what we're seeing is something like 3 million households being affected by this benefit cut. On average, about £1,700 worse off, with around 800,000 people no longer getting personal independence payments. And if you look at our distributional analysis, so you will always be guaranteed a complex fiscal chart and a distributional analysis chart. If you come here, it shows that around 2/3 of the impact of those cuts are on lower income households. So it's really hitting some of the most vulnerable households, with the government's impact assessment showing that around 250,000 people move into poverty as a result. And things get worse if you look at some of the details of this. So if you focus in on some family types, I won't go through all the case studies that we've included on this slide, but some families are really going to be hit hard by this. So if I focus you in on the family that's losing £10,300. That's a couple on UC where one person is getting PIP, the other is a carer, and they lose access in a double whammy to a range of benefits altogether. And you get really big impacts when you look at it in this space. So that's all very grim. You can also see that from the process over the past few weeks that these changes have been really rushed, and the OBR yesterday said they didn't have enough time to really get to the bottom of some of the scoring and the indirect effects of all this. So there's more to come on this, but history tells us that doing benefit reforms in that sort of way, in a very rushed way, rarely delivers the sort of savings that are hoped for. So plenty of debate to come on all this, but let me finish by showing you where all this leaves the living standards outlook. And this chart just shows the forecast for the ABR forecast for real household disposable income. You can see we've put this in Parliament terms. You can see the forecast implies that the current Parliament is definitely nothing to write home about. It's the third worst on record, in fact, so very weak living standards. And we're basically in a position where the 2020s is now looking like a disaster of a decade, particularly relative to the two preceding it in terms of living standards. So very weak growth there, and things really get worse if you zero in on the bottom half of the income distribution. So what this chart shows you is our work taking the OBR forecast and looking at the distributional implications of that forecast. And you can see at the end, the red bar, this is a 5-year change in living standards for that group. They're basically at recession levels in this forecast. So quite similar to the 2000s, quite similar to the 90s levels of recessions, and we project incomes for this group falling about 3% or £500 on average. So a really tough outlook, recession-like outlook for living standards. All right, that's my whistle-stop tour. Let me leave you with my key takeaways. So the Chancellor, we think, was right to respond to worse fiscal outlook, but has backloaded the policy response to that, and so borrowed more in the interim, and has rushed these regressive cuts to benefits. And all this really doesn't match the world has changed rhetoric with the policy response, and looks a bit more like a sticking plaster in terms of the policy changes that we've seen. And all this leaves a really sort of bleak outlook for living standards, particularly for those on lower incomes. Let me leave it there.
Thanks very much, James. So Richard, over to you, and anything you want to add on the forecast that James has taken us through, but perhaps also some of the other scenarios in the document that you cover.
Yeah, thanks. I think James did a very comprehensive job of going through what was in our central forecast, and it's certainly the case that since the last forecast we did back in October for Rachel Reeves' first budget, the outlook is significantly more challenging. I think I'd also underscore that the outlook is a lot more uncertain at this stage, and we're doing a forecast which, as today's headlines have illustrated, was being done against a rapidly changing global environment. The central forecast is tougher, as James was pointing out, partly that 2024 turned out to be a worse year in terms of GDP, household confidence, consumer confidence, business confidence. It looked as though in 2024, in the first half, there was quite a bit of momentum coming out of the pandemic and the energy crisis. That momentum just stalled in the second half of last year. So we doubt, in the end, last year came in about 0.2 below our forecasts for 2024, but the slowdown in the second half of the year was much faster, where we thought actually that momentum was going to be maintained and then increase into this year. So the economy is stalled now almost for 3 to 4 quarters, and so that slowdown continues into our current forecast. As James also pointed out, interest rates are a lot higher. That's bad news for households and businesses, also bad news for the government. more than spoke for the Chancellor's headroom. So all that led to a weaker near-term picture, a sort of tougher picture against the fiscal rules. The Chancellor did just enough to get exactly the headroom she had back in the autumn back to around 10 billion through the various measures that James set out. But I think one of the things which we really tried to stress was that £10 billion is really nothing compared to the risks around the outlook, and a number of which weren't reflected in our central forecast because they hadn't been announced yet. A very big one was tariffs. We've had some tariff announcements this morning. We're expecting more on the 2nd of April. And so around us, our central forecast didn't include any tariffs that had a significant impact on the UK because so far Trump had just announced Mexico, Canada, and China in steel. But if you look at what happens if tariffs go up to 25% across the world, on all countries, including the UK and the EU and the rest of the world, that could knock about 1% off GDP next year and about 0.75% of GDP in the medium term, even after you've adjusted trading patterns to the new set of relative prices. That itself is enough to wipe out all the headroom against the Chancellor's fiscal rules. And it kind of doesn't matter whether we retaliate or not, because the problem with retaliating is you put up tariffs, you get some tariff revenue, but you also put up prices for domestic businesses and households, and that suppresses demand and suppresses domestic revenue. So, retaliating might work if it can help end the trade war and get the other guy to take the tariffs off you. But if everyone's just put higher tariffs on everybody else, fiscally in the UK, based on our modelling, you're not really better off. It doesn't really help with the sort of bottom line of the public finances, and it makes life harder for people trying to do business and go to the shops in your own country. So tariffs are a very big risk to the outlook. Some of that risk has already started to materialise this morning. Interest rates, obviously, we've seen about a 0.5 percentage point rise in interest rates since the autumn, as James was pointing out, an awful lot of that driven by what's going on in the US, not what's going on in this country particularly, but also what's going on in the Eurozone. Germany has now got a very different fiscal strategy than the one which the Germans have been pursuing, for the last 50 to 70 years. And so that is, that's pushed up German bond yields as well. And so, government debt is a commodity, it gets traded on markets, they're substitutes for each other, so that can also affect our borrowing costs. If we saw same again on interest rates over the next 5 years, then that would also wipe out the headroom that the Chancellor set aside for herself. And then the final thing I'd really stress is that the outlook for UK productivity growth, independent of all that stuff, just trying to figure out what the latest data we've seen out of the ONS for population, labour force, and GDP, when you put them together and try and figure out what that means for productivity, at the moment it is a very cloudy picture, partly because those data sets get updated at different points in time, so you never quite know whether you're looking at something which is like for like, and also because there are these notorious issues around the quality of the labour force survey. A literal interpretation of the ONS data from the second half of last year would tell you that the productivity of the UK economy fell by 1%. That is not what's included in our central forecast. Sort of either we've taken the level of that going forward, but we don't think there are going to be continued falls in UK productivity over the next 5 years, because it's hard to quite make that stack up with any view of what's happened to the UK economy. We do have a lower level of productivity in the medium term, but it does return to what is our sort of medium term growth assumption for productivity, which is around 1 3/4. But that's something which we always keep under review. We will take another look at over the summer once we get some more complete ONS data, and that's always a source of significant uncertainty around our forecast. It takes just 0.1 off the rate of growth in productivity over the next 5 years to also wipe out that headroom, because it affects basically all tax bases in the country. So, the Chancellor rebuilt her headroom, back to the £10 billion she had back in the autumn. When you stack that up against all the risks of the outlook, it starts to look pretty small.
And just on what you said about the kind of world's been changing as you've been preparing this forecast, Trump's changed it again this morning. How much of that changing world is in this forecast versus is kind of to come and is in the uncertainty?
Donald Trump's policy making doesn't follow our deadlines for notifications of policy. So for that reason, the announcements that he's made today are not in there. The announcements he's proposed to make on the 2nd of April are also in there. If they turn out to involve as he is threatening tariffs going up to 25% against the entire world, then that is not in our forecast, and the impact that it could have in the near term is about 1% off the level of GDP, medium term about 3/4, and fiscally that has a big hit to domestic revenue generation and takes the 10 billion to zero pretty swiftly.
Thanks very much, Richard. And Linda, what did you make of yesterday?
Yeah, thanks, Drew. Thanks very much. An excellent presentation, James, and really good to hear Richard as well as read the analysis. So I suppose there's probably a lot to say, but I'll just pick a few things. I think maybe picking up a bit on when I was watching yesterday, the impact of the fiscal rules, the stability rule, so therefore the need to respond to an updated forecast. So I think we know the Chancellor would prefer to have one major fiscal event per year, for instance, the budget in the autumn. But the OBR does semi-annual updates, and if you look at the bank, they do quarterly updates, the IMF does quarterly updates. The world is highly uncertain, as we're saying now. So, having updated forecasts is useful, despite everything you just said about that's not in there. But I suppose the reason I was reflecting on it is that this fiscal rule that day-to-day spending must be balanced over the course of the Parliament, essentially through tax rises or spending cuts. That stability rule is a necessary but insufficient condition for growth, which is the strategy the government wants to undertake. You need that stability in order to grow. The other fiscal rule, investment, is geared at growth, and I think we saw that the envelope for that has actually increased. But I want to focus a little bit about this impact of the stability rule, which I found a little bit almost ironic. Because of the stability rule, she had to respond and make changes to public spending, because that literally is the rule that she's abiding by. So we're getting stability in the credit market, but we are introducing an impact on the real economy. And policy uncertainty is one of the things that firms and businesses would like to have less of. That's why the Chancellor wants one major fiscal event. You don't want, as a business or household, to have to adjust for changes in fiscal policy. And if you look at surveys of firms, what puts them off investment, the top reasons are uncertainty, which could be macro, policy, regulatory, skills gap, and not surprisingly these days, inputs, energy, supply chains. So if firms could be hesitant because it's uncertain, and the stability rule means there could be changes like what we see now twice a year, I think it just it works a bit against the idea that we need them to invest, because the reason we are growing slowly is because we lag comparable economies in the level of investment. That's pretty well trailed now. So we need to raise investment, and therefore the introduction of the investment rule is to allow government to borrow to crowd in investment over a longer period, which can boost growth. And we saw that a bit on the planning side, on the infrastructure side in the October budget, both scored by the OBRs, having an impact on the potential growth rate. So I suppose that was sort of my observation, watching it. I think it's sometimes called in policy circles an unintended consequence that this can happen. So I don't think there's any choice but to do it, but I do wonder if in this environment, this is indeed what we're going to be facing. And I think the other thing I was just going to highlight is around, if we, so thinking about why again this is going to be a regular occurrence, is because the OBR's analysis points out that the tax take will be at historic high, about 37.7% of GDP. But the government spending is another 7-8 percentage points above that. So therefore, there's a structural gap that is always going to have to be filled by changes in current spending, because that's, and there is an issue there about if the tax as a share of GDP doesn't quite match public spending. I think we'll probably need to wait to for the spending review to see how that gap is closed. But we're basically just, I suppose, at the moment, we don't have information on that. So this has also come before the spring spending review, which is also, I guess what I'm trying to say is by June, we could find more policy changes on the back of the comprehensive spending review, which was set out at least for 3 years of the next 5 years of spending for all government departments. So, James presented a bit of that. So I guess that's my way of saying, I'm not sure the stability rule is quite providing the stability in policy that we might hope the name entails, but it is hopefully providing the stability for our creditors' bond markets.
It's really interesting, and on stability, I guess the trade-off is once she set her rule, and we should say there are some features of that rule that in the future allow for a range but didn't at this event. But given the rule she had for this event, I guess one way to provide more stability would be simply to have had more headroom, and that would have made it less likely that she'd had to adjust, but that would have meant higher taxes or lower public spending from the start. How do you think we should think about that trade-off between higher headroom lowers the uncertainty? I mean, it's a clear one for this event. She could have said, the world has changed, I needed a new tax to pay for defence, and then there'd be less uncertainty going into the autumn, but we'd have a new tax. How do you think about those trade-offs?
Yeah, it's a really good way of putting it, because I think Richard gave the figure, and I think analysts have put it roughly the same, which is even if you have a change of 0.1% of productivity growth, it's about a 7 to 8%, 7 to 8 pounds impact on the fiscal situation. We have a really hard time estimating productivity growth, which underpins the growth estimate. So she could try to give herself more headroom, but just thinking about the absolute numbers of what that means, you're making choices which are hard to do. And we know that part of the reason why the economy is slowing is because of the October budget putting in tax increases. So the stagnation that we've seen over the last few months has an immediate impact. So you can try and fix the numerator, but what happens to the denominator, which is GDP? So I think that is actually, that is really challenging. So, in this world where you could have across the board 25% tariffs on the world, which, by the way, I can't think of anything like this in recent memory. So World Tariff Day coming on April the 2nd. I'm not sure if you, honestly, I was thinking, sometimes with businesses you say you need to take no regret actions. How do you do that when it's so uncertain? And then if you negotiate a tariff, there's about 185 jurisdictions in the world, and everyone goes to USTR to negotiate this. How much capacity do they have to negotiate this? Are we first in the queue? I hope so. But I guess that's my sort of question. It's so uncertain that then you make changes that impact people's lives on the basis of a scenario where policy could change, from day to day. Then there could be a truce or a delay or forget about it. Am I just being really optimistic?
Great, thank you so much, Linda. Right, look, it's a pleasure to see so many people in the room, so I think we should give you the privilege of asking some questions. We'll take one here and then any others in the room. Joel at the front as well, please.
Thanks. I'm part of the problem, the ageing population. So I've been involved in these things since the Prices and Incomes Board in the 1960s. The missing subject in these forecasts is surely inflation. That the background is that people, consumers, are much more worried about inflation. I live in the north of England, so I can see them, than the policy makers in Whitehall realise. And inflation is ticking up to twice the 2% level. And likely as a result of these tariffs, the effect's going to be on expectations about inflation more than on demand in the short term. So what's the panel think about, are we ignoring the fact that we may have a lot more persistent inflation with also wages coming up 5-6% again, than the OBR seems to realise.
Thanks very much. Shall we come to Mark front? Thanks.
Thanks very much. I have two questions. Joel Hills from ITV News, both for Richard, if I may. The first, Richard, based on what you were talking about, the uncertainty and making an assessment of productivity growth, what probability do you think there is that the OBR will downgrade the trend growth rate of the UK economy in the autumn? Probability. And secondly, and if you can answer this question first, in terms of World Tariff Day, something definitely to celebrate, what impact will 25% tariffs on US imports of cars have on the UK economy, and will it be significant?
Thanks, Joel. We're gathering quite a few for Richard, so let me give him a chance to come back on some of them. Inflation forecasts, tariffs, and
James used to be at the Bank of England, so he could answer the inflation question. He's looked at more inflation numbers than I have in my life. I mean, in terms of our forecast, you're right that in the last few years, the big hit to living standards come from the fact that inflation has outpaced nominal wages and earnings. What you've seen in the last year or so has been wages going back to outstripping inflation. So that's offered households a bit of relief in terms of disposable income. Over the medium term, we think wage expectation. You're right that real wage growth has turned out to be more persistent than we thought. And it's one of the things which is pushing up on inflation in our forecast. The big thing that pushes it back up to 3.8 this year is actually gas prices going back up. We had a cold winter, not enough gas going into European storage. But actually gas prices have proven incredibly volatile. And the one thing that offers a bit of relief, I would say, against even the forecast that we finished a few days ago is the fact that European wholesale gas prices have come back down. That might mean possibly less of an increase in household bills because we are a country that remains extraordinarily exposed to gas prices, and we are very gas dependent. And that's one of the reasons why we had such a tough time with the energy crisis. If pressures on gas prices alleviate, that could help mean that the peak inflation this year is lower. But you're right that in terms of the pressures that come from domestic wages, that is still there and proving to be more persistent than we or the bank thought. We do think that you've got kind of one more year of above target inflation, and then it's back to the 2% over the medium term, but that remains very uncertain. On productivity, I mean, look, we'll be led by the data. We will see what future combinations of ONS, population, labour force, and output data suggests. The ONS is having a tough time keeping track of how many people are coming into the country, how many people in the labour force, and what they're producing in terms of outputs. These numbers get revised a lot. We will take another look at it in the summer and come to another view in the autumn, but also taking account of what we think changes in things like trade policy, energy prices, and other things, and also government policy measures might do to the outlook for productivity. And in terms of the impact of tariffs on the car sector in particular, I confess I didn't go into the office and rerun the model just for 25% tariffs on cars. But the UK exports about £60 billion worth of goods to the US. That's about 2% of GDP. About 6 billion of that is cars, and so you're talking about, in terms of a direct effect, in terms of a direct effect on UK exports, it's about 0.2% of GDP. Suddenly getting more expensive to sell to the Americans. How they respond will depend on the elasticity of demand for UK cars, which is not a number I've got in my head, I'm afraid. But it will have an impact, and it's the beginning of the crystallization of a risk that we were concerned about when we put the forecast together, and it affects a significant proportion of our exports to the US.
And Linda, I know it's something you've thought about before on World Tariff Day, is in terms of who that would impact rather than just the kind of macro impacts. Can you tell us a bit about that?
Everyone? Let's see, 25% across the board tariffs. Well, okay. I think on the U.S., you would expect retaliation. So I think the expectation is it raises U.S. inflation. The impact on global inflation is less clear. You can see reports already of businesses negotiating to cut costs. So I think on a balance, it's not quite clear what happens globally on inflation. In terms of the countries most impacted are the countries which obviously run big trade surpluses with the US on goods. So that would include Mexico, Canada, Vietnam. So, basically the countries which, many of which have already been in the crosshairs. It's also going to impact countries which are connector countries. So countries which think about supply chains as not widgets for wine, but intermediate goods and products. So there's countries which are in supply chains, which, for instance, emerging economies in Asia, they're very integral to global supply chains, global value chains. They will be impacted as well because they're part of the feeding into these countries with big trade surpluses. And for those countries, I think the growth impact would be pretty substantial. So what does this mean generally for cost of capital, which is obviously why another area where it could impact the UK is if the US has higher inflation rates, they're higher for longer, growth might be obviously, depending on what happens, impacted, then the cost of capital could remain higher for longer. Right now it's in restrictive territory where interest rates are, and that could have a dampening effect on growth. I'm going to stop because if I keep going, I mean, this is...
it's not cheering us up.
No. And as I say, this is... it's the art of the deal. It's all to be negotiated. I'm just worried about the queue. Like, who's going to be in the queue to negotiate this quickly? So.
And James, we've had a couple of questions online about spending cuts. I wonder if you might just take us through. You covered it briefly, but actually, there's quite a lot going on under the hood of capital and resource, and some people online perhaps thinking there are quite big spending cuts in this statement, but that wasn't quite our take.
Yeah, I glossed over it a little bit in my presentation because there is a lot going on. The changes aren't actually huge, but basically what's happening in this forecast is part of the tightening measures, and you have to think about this in the context of the current balance rule that the government has. So balancing day-to-day spending and tax receipts is coming through this day-to-day public services spending cuts, but as I was pointing out, that those cuts are quite backloaded. So I suppose the question you could raise is, will those end up actually happening, or does the Chancellor hope she'll get a chance to actually revise those plans, as we've seen sometimes in the past? But the other reason borrowing doesn't fully close in terms of how that's changed relative to the autumn budget is because the Chancellor's actually, rather than cutting capital spending as many governments have done in the past, a welcome implication of the change to the fiscal framework that we saw at the autumn budget is that no longer helps the government, because of this current balance rule, meet its fiscal rules. So that's very positive. The mistake of the past has been to slash capital spending whenever belt tightening is needed. That's not happening now, and in fact we got a small upgrade, particularly in the context of higher defence capital spending. So if you want to get into the entrails of funding higher defence spending, there's a lovely section in our document about the switches between day-to-day spending and capital spending and ODA spending, the overseas aid budget, and what that is actually funding, where you sort of end up with a situation where that aid budget is actually funding some other departments on day-to-day public services spending. So you might question that choice. Can I just say very briefly on inflation? So I don't like the way this event has started. People seem to be trying to outgloom me, which is very off-brand. I don't like that. So, maybe we're headed to a super high inflation world, and there's definitely, as Linda was saying, this effect of inflation from higher tariffs. I suppose, as Richard was saying, that there's a scenario here where you get some resumption of supply of gas from countries that have been stopped from supplying because of the conflict in Ukraine. So gas supply situation improves. You've seen some of that already priced into markets. You could see global commodity prices falling. They're very sensitive to world trade. And if you think about the sort of distributional impact of what's been happening, this exceptional period of really high inflation, that's hit low-income families hardest because it's been in those essentials, energy, food, and food is sensitive to higher tariffs, but if we got some falls in energy prices, then there's a better scenario here in which some falls in prices could potentially boost incomes at the bottom.
Thanks, and I'll come to questions in just a minute. I think just on spending, worth highlighting that we do look at these cuts to what are known as unprotected departments. Those have actually, for the fiddly reasons that James described, got slightly lower, we think, in this forecast than in the last. So this isn't a big change to the challenges of the spending review at this event. Can we take a question from Sam at the front? Thanks.
Come on, Greg.
From the FT. Richard, can I ask a bit about the planning changes? Obviously, that there's a perception going into this that the OBR was relatively reluctant to score some of these growth measures, regulatory measures. Could you talk a bit about the background to that decision and whether that reflects any change in the approach within the OBR to how it examines these sorts of reforms? Thanks.
Thanks, Sam. And I think there was one there as well, just next to you, Greg, while you're there.
Hi, John Paul Ford from the Daily Mail. Just a couple of things, please. One is on the risks to the headroom. I wondered if it's possible just to roughly quantify how much of that has already gone, because clearly since the cut-off point for interest rates for bond yields, they've actually gone up a little bit already. And then we've had the tariff announcements since then. Is there a rough estimate of the 9.9 billion, how much has already gone, even before we get into the things that might happen over the next few months, a third of it, half of it? And then on the RHDI living standards, which 0.5% on average each year are going up, that's premised on the freeze in tax thresholds ending, which seems a bit of a heroic assumption given the pressures the Chancellor will be under in the autumn. Everyone seems to be saying. So is that something which, that increase in living standards is actually something which is very unlikely to happen, as the OBR central forecast suggests?
Right, given that was a few questions in one, let's come back. So planning a new forecast for headroom already, please, Richard, and tax thresholds and living standards, and I'll see if anyone else wants to come in.
So on planning, I think this was a sort of a further step in our attempts to be more transparent about how government policy can have an impact on the supply side of our forecast. It's always been the case that we've taken account of government policy when we think about the drivers of potential output, which are the labour force, business investment, public investment, and total factor productivity. And it's always been the case that when we thought that things that government was doing could have a big impact on those measures, we'd reflect it in our supply side forecast. Things like measures that get more people into the labour force, or things like people that bring in more labour force from the rest of the world, things like public investment. But what we've tried to be over the last few years is just more transparent about the mechanics of that and put in place some proper modelling, write some articles, write some papers, and show how it works. It's most straightforward to do for things like labour supply measures, because you can just say, look, this many people rejoin the workforce, that adds this many people to labour supply, make an assumption about what their average wage is, and then that can get you to their impact on output and incomes. Similarly, for things like public investment and government investment, to say something nice about the ONS, they've got increasingly good estimates of the public and private sector capital stock, which you can show the impact of public investment and private investment on, and how that supports potential growth into the future. And then on TFP, we know that regulatory changes can have an impact on the productivity of different sectors. It has been a pretty widespread view amongst the economics community that the planning system was a big constraint on both the productivity of the construction sector, as well as a constraint on just economic development in areas which are, generally speaking, kind of high wage, high productivity areas, especially around big urban centres. We do think that the planning reforms the government announced last year and kind of finalised in December, in particular the ability to build on the green belt, where there's a lot of housing demand, access to good quality work, and an ability to build houses with a pretty high return to the industry and to the economy, will make a material difference to the outlook and boost housing supply by about 170,000 over the next 5 years. I mean, to put that into context and to just underscore how hard it is for governments to move the dial on things that matter for growth, the total stock of housing in the UK is 32 million. Based on these reforms, they're going to build an extra 170,000 over the next 5 years. So that's an extra 0.5 on the housing stock in 5 years' time. And the difference that makes to the level of output in our potential output modelling is 0.2 on the level of output in 5 years' time. Not even 0.1 on the growth rate over those 5 years. But nonetheless, look, it's worth having. But I think it underscores the fact that trying to get growth, trying to do things that make a meaningful difference to the growth potential of a country are things which take a long time to make a difference to, require patience and kind of stick-to-itiveness. When we looked at the planning reforms and talked to the industry about how they were planning to respond through their own planning applications and their own investment plans, they were pretty positive. We also talked to housing experts about what they thought. And we had the impression that it was going to make quite a big difference to people's investment decisions. Whether those houses get built also depends on a whole range of other factors, whether you can get access to the people to build them, what the other regulations are on the housing sector. And so those are things that we'll also have to keep an eye on, and also just the general state of the housing market.
And just on planning, Richard, before you move on, how do you think about the additionality of whether a measure is kind of additional to your baseline, which is based on some kind of historic averages in some sense, in some ways, and whether this is kind of going above and beyond that baseline or not?
Yeah, so the estimates are based on where you think the sort of baseline trajectory for the housing market is, which kind of builds in, and it's fair to say a bunch of new regulations have come in, which have had an effect on house building in the sector around affordability, around fire safety, around the environment, and that's had a sort of that's had its own impact on the sector and it's depressed house building in the past few years. As the industry adjusts to those, we do think it will respond to what is pretty strong demand pressure for housing growth, and that these reforms will allow the industry to respond more effectively to those. And we sort of add those houses on top. The growth is pretty backloaded in the sense that we think it takes a while to get the houses built, completed, and sold, which is what really matters for the economy and also the tax receipts that are generated from the extra houses. So a lot of that growth happens at the back end of the forecast, but we nonetheless think it's going to make a difference. Unfortunately, we don't do daily headroom estimates, I'm afraid. Some of the risks that we thought were going to materialise were there. I think on interest rates, compared to the volatility you've seen in the last 6 months, the sort of volatility in interest rates over the course of yesterday were pretty modest, I would say, and not a particularly big reaction to the fiscal statement itself. So I would say those things are kind of within the usual kind of the usual sort of noise that you see from day to day in markets. And yes, it's true that our household disposable income forecast assumes that the thresholds on the personal allowance and other tax thresholds are indexed in the final 2 years of the forecast. So the freeze ends in 2027, 28. And part of what alleviates the pressure on households going forwards is the fact that they're feeling less fiscal drag from those thresholds.
Great, thanks very much, Richard. Did anyone else want to come in on those, or otherwise I'm conscious of time, I might squeak in a few extra questions. There's one online which maybe we could also bring up on the screen. Now, this is not a question for us, I'm afraid, so I'm not going to suggest that we answer it. It's a question for the government, I think, about kind of the pace at which these welfare changes has done, which, as James says, at the Resolution Foundation, we agree comes with risks. But I wanted to use it as an excuse, Richard, to ask you a bit about the kind of employment effects of these measures, conscious that in the EFO you don't assess those. So interested to know whether you think the the direction of those effects is clear, whether they're definitely positive or not. And then James, perhaps I can come to you. We talked about the kind of average distributional analysis of these welfare measures, but there's some quite concentrated effects, as you said, and how that compares for households with someone who's disabled and someone who isn't.
So at this stage, I would say hard to say. As you pointed out, we got the welfare package very late in the day in our forecast process, and quite a lot of it, there wasn't very much detail about specific policies, and also not the usual kind of analysis that we would get alongside policies from the Treasury and DWP about these kind of indirect effects and about knock-on effects for employment. And so it's something which we're going to have to take a look at again between now and the next forecast to see what we think its employment impacts might be. Part of it is going to await the government actually filling in the details on what its employment support program is. At the moment, they have basically just said we are going to have an employment support program and it's going to cost £1 billion.
And £1 billion in 29-30.
And £1 billion, yeah.
Sorry, only 200 million in the year the cuts actually come in.
Well, precisely. And so, how much activity is going on in each year of the forecast, and which people are being affected, what kind of support is being provided, how it interacts with the changes to the various gateways in the system, also with the changes to benefit rates really matter. We have looked at similar schemes in the past, previous governments have also made attempts to provide more active labour market policies for disabled people to try and help them back into employment. The last attempt was back in 2023, and the government was spending, I think, around 400 million a year on those kind of measures. And I think our estimate at the time was that it was sort of a few tens of thousands supported back into work. Because the thing to bear in mind with this group is that they are quite far from the labour market. They require quite tailored interventions to support them back, and quite comprehensive support. Sort of how quickly you can put that in place, and how many precedents you can draw on to try and assess employment impacts of those kind of sometimes quite novel interventions is not easy, but we'll have a look at it over the summer and see what we think.
Yeah, and I think it is helpful when you think about the welfare reforms to sort of put them in two buckets. One is a set of changes to universal credit and additional employment support, which will affect the incentives to work, and which we'll look forward to Richard's analysis of whether that will get more people into work. And then separately, these kind of big cuts to PIP or disability benefit, a benefit that is paid regardless of whether people are in work, and therefore where it is harder to see that you would get big employment effects. And you can also do some sort of thought experiments about, let's say the government did really excellent employment support and got 10% of people in work more than otherwise, and let's suppose that all of those people earn enough income to offset all of the losses they suffer. Given we start with 3.2 million losing from these changes, that still leaves 2.7 million people losing. So the idea that employment effects could completely offset these losses seems a little bit for the birds. James, do you want to add on distributional analysis?
Yeah, just very briefly. I didn't get a chance to talk about this earlier, but we have a distributional analysis for all the changes that the new government have brought in. And you can see by adding in the national insurance changes that we've seen, those are broadly progressive but quite large tax changes. One thing we highlight in the overnight document is how big a dividing line disability has now become. So if you look at the impact of all those policies across households that self-report that they are disabled or not disabled, have a disabled or not disabled members, the biggest impact of all those policy measures for non-disabled households about 0.4% of income. That comes around the middle of the distribution. If you look at households with a disabled member, that's 6 times the size in terms of the overall impact, and the biggest impact is about 2.6% for the bottom fifth. So disabled households faring much worse, particularly lower income disabled households. So that's become a really big dividing line for the policy changes of this government.
Thanks very much, James. I'm tempted to come to our poll and then I'll come to Linda first, perhaps, on it, which, Richard, we thought you hadn't done enough forecasting, so we thought we'd look to the future a little bit. Can we bring the poll up? So the world's changed a lot in the last 5 months. How might it change again in the next 6 months? I'm sorry to lighten the mood, but it was all getting very gloomy. So feel free, if you're online, to vote on Slido, which will make us allowed to generate some fun results. Feel free to log into your phone and vote in the room. So our options are all-out tariff war, European economic renaissance, by which I think we include the UK in a new protocol, peace dividends, success in kickstarting UK growth, better productivity data for Richard to take in the autumn, and dole Q Britain welfare reforms not going as well, perhaps the jobs market continuing its recession-like behaviour. So feel free to veer out of these categories on the panel, and I might bring in, this is going to confuse, so I will just read it out, but we had a question from Tim Wallace at The Telegraph, relatedly about whether the Chancellor will need to come back for more in the autumn, what sort of tax rises and spending cuts might be on the cards. So perhaps I'll ask the panel to comment on those two things together. What's going to happen next, Linda? What do you think?
So I wrote a book called The Great Economist, and the great economist J.K. Galbraith said the sole function of economic forecasting is to make astrology look respectable. So we're really, but you're right, it's good to lighten the mood a little bit. Let's try and look at what could happen. I'm curious to see what everybody will say, because I think on this, if I just touch on each of them, all-out tariff war, I think we're in a tariff war already, because it's not just the imposition of tariff, it's the threat of tariffs. So coming back to the impact, the International Monetary Fund did an estimate on the previous global tariff of possibly 10 to 20%. 25% is even higher, so the impact will be worse. It would knock 0.8% off of global GDP growth. Global GDP growth is around just over 3%, so it's pretty substantial. And even without it, as I say, the uncertainty could actually dent growth. European economic renaissance, I'll take that with the peace dividends. So I think we've had a period of peace dividends. And if you look at some of the research around defense spending, there is a link to the technologies spent in defense being dual-use technologies that could increase growth. And in many ways, the US, that's where the studies have been done on. The US has done that. So I think moving defense into capital, I think, is a way of, I think we need a bit more research on that explicit link, but I do think there is something there. UK growth kickstarts, yes, please. Oh wait, is this about what we want or what we think is going to happen? We have to start at some point. Richard talked about the housing stock. I think about planning reform for critical infrastructure that we need, whether that's data or energy or all of these things. Growth takes time. So I do think that, quite a lot of policy is geared at getting growth started now. We won't see it now, but if we don't start now, we probably won't see it in the next 6 months, which comes to your last question, which is that dole Q Britain kind of ties into the previous comment as well. I think because there's a structural gap between the tax take and public spending, I think there will have to be hard decisions around, can you actually, with the Labour Manifesto ruling out about 2/3 of the tax base, there is a gap to be closed. How you close that gap will be very, very difficult, painful. And I think the principle we always, which is why I'm here, we want to always consider is, can you do it in a way that doesn't harm the least well-off, but also address some of the issues, what you were saying before, which is around economic inactivity. So we have a high level of economic inactivity that hasn't returned to pre-pandemic levels relative to comparable economies. So there is quite a bit of work to be done there. And then just very finally, because this is the point I meant to make earlier, if interest rates stay higher for longer, our debt is linked to index-linked gilts. So if you look at the biggest categories of public spending, about a quarter, as we know, is welfare. That's just over 300 billion, and about 16% is health. Third biggest category is debt interest payments, about 100 billion pounds or so. It's more than education, it's more than the others. So if interest rates stay higher for longer, then I think you will have this impact on debt, which means that gap I'm describing becomes even harder to close because you're now widening the gap. Anyways, my takeaway, because I know we try not to be too gloomy, is we focus a lot on the numerator. It's always debt to GDP. Let's think about getting the denominator, GDP, going. And historically, that helps a lot. You've got countries out their history.
Absolutely, although in some ways yesterday is an illustration that at the moment the fiscal position seems a bit more dependent on the cost of borrowing than it does on actually the growth outlook, and that's become really striking, I think, in some of the OBR's recent forecasts. Yeah. Richard, how are you feeling about the next 6 months? That's what everyone wants to know.
I guess looking back on the last 4.5 years that I've been doing this job, it has been marked out by just a series of major economic and fiscal shocks hitting all advanced countries, including the UK, the pandemic, the energy crisis, and as Linda was saying, the normalization of interest rates is in some ways have been the most painful and lasting shock that all countries have faced, and chancellors in particular, because they've got to pay the bills. And that one, interest rates, if you believe the markets, kind of interest rate pressures abate a bit over the medium term, but not very much. And so I do think that and now we've got potentially in a sort of tariff escalation scenario, and creating further pressures and headaches for chancellors. I do think all that experience has underscored the need to maintain sort of fiscal nimbleness in the space of responding to shocks, which either comes through having extra headroom or being able to just change around the levels and compositions of tax and spending, as you've seen successive chancellors do.
Maybe more than once a year.
We'll do 2 forecasts a year. Governments have choices about how they want to respond to those forecasts. I think one thing to bear in mind is in the summer the government's going to lock in 40% of public spending for 3 years. And when they do that, they need to do that with the confidence that is, they are ready for an uncertain future in the plans they set out. And so I think it's important also just basically be ready for anything and be ready to adjust policy if you need to in response to a changing world.
Yeah, it's a really good point about the autumn. So on this question we had about whether the government will have to come back for more in the autumn and what the options will be available at that point. As Richard says, once we get to the autumn budget, the spending totals will be allocated to departments for all but the year before she has to meet her fiscal rules. And so that will make it much harder to make spending changes as the way to meet them. James, is she going to have to come back for more?
Yeah, well, I was going to have a crack at being optimistic here. So I'm a bit out of my comfort zone, so bear with me. But I think a scenario in which you have falling energy prices, so picking up a little bit on what's going on in commodity markets, allows inflation to fall back potentially quite sharply. You see central banks stepping in to support their economies, and maybe the UK flies a bit under the radar in terms of an all-out tariff war. That could be a scenario in which inflation's a bit lower, the fiscal position's a bit better given its dependence on interest rates, and we end up getting a bit of growth. But yes, I think given to the question earlier, we've seen rates rise since the Bank of England decision last week. So there's another sort of 20-30 basis points on long rates. That's chipping away to a large extent at that headroom that's already there, and we're already seeing some of these trade risks crystallize. So there has to be a big chance she comes back for more. It's a full fiscal event. Taxes are in play. Our view was for this fiscal event that taxes should not have been ruled out. That's the fairer way of putting the public finances on a sustainable footing. That would have affected far fewer people, more people towards the top of the income distribution. So wouldn't be surprised to see more of that.
And in some ways, actually, when you look at this event and you digest the spending numbers, she's actually chosen, despite the briefing before the event, to largely protect public spending and to really concentrate the changes on welfare. So let's see how the spending review goes. I'm sure it still won't be easy. Let's have the results of our poll, and then conscious it's a very busy day, and so we will let you all crack on with it. And unsurprisingly, given the headlines this morning, I suppose slightly less optimism out there in the world than from James. Thanks very much for coming. There are more copies.
13% of optimists. Yeah.
There are more copies of the document, if anyone didn't get one now, available upstairs. And thanks to everyone who joined us online.